A renovation mortgage is a type of home loan that allows you to borrow money to complete updates, repairs, remodeling, or to make other improvements to a home. A renovation mortgage can be used when you're purchasing a fixer-upper, for example, or if you'd like to improve your current home, you may choose to refinance with a renovation mortgage. There are several types of renovation mortgages to meet the needs of different borrowers, and your PrimeLending loan officer can help you with all of them. While there are many different renovation products, the most well-known are Fannie Mae's conventional home-style renovation loan and FHA's 203K renovation loan. Some jumbo investors also offer renovation products for the needs of jumbo borrowers, and there are many niche renovation products for things like swimming pools as well. While there are differences between these programs, there are many things common to all renovation loans, so it's important to understand the basics of how renovation loans work. A renovation mortgage requires a borrower to do some homework up front to determine the amount of money needed for the work they want completed. Whether you're purchasing or refinancing a home, you'll need to get quotes or estimates from a contractor. This is especially important when purchasing a home because the cost of renovation may impact your offer price for the property. Why does a borrower need to complete this work up front? Well, when the home is appraised, it will be appraised in as-completed condition. This means that the appraiser will take into consideration the improvements that are being made and will value the home as if the work has been completed. This helps to ensure that the home isn't over-improved and that the value of the home after the work has been completed can be supported by the new loan. Let's look at an example. Let's say you're purchasing a fixer-upper and plan to offer $100,000 for the home. The price you offer should take into consideration the current condition of the property. You decide what improvements you want to make, get estimates from a few contractors, and choose a contractor that provided an estimate of $40,000. When PrimeLending orders your appraisal, they will provide the appraiser with a copy of your contractor's estimate. After taking into consideration all of the improvements you plan to make, the appraiser assigns a value of $110,000 to the home. This would be problematic since the purchase price plus the cost of renovations totaled $140,000. In this example, you may choose to lower your initial offer for the property, or you may choose to revise the amount of work you want to complete so that the home will support the after improved value. You may also come to the decision that the amount of work the home needs to meet your specifications isn't worth investing and move on to another property. Using this same example, if the appraiser assigned a value of $150,000 to the home, the as-completed value of the home would support the amount of the improvements. Now, there are several important points a borrower should understand about a renovation mortgage. A contingency fund will be established, and it can range from 10% to 20% of the total estimate. The contingency fund protects the buyer, the contractor, and PrimeLending from unforeseen cost overruns. After the project has been completed, any funds remaining in the contingency fund are applied as a principal reduction if the contingency fund was rolled into the new loan, or they're refunded to the borrower if paid out of pocket. To protect both the borrower and PrimeLending, the contractor must also be validated to ensure that they hold proper licenses if required and have insurance coverage. PrimeLending utilizes a third party for this process. Generally, all that is required from your contractor is to complete a short contractor profile report and provide their W-9, proof of license, and insurance. PrimeLending does not approve or recommend contractors. When purchasing a home using renovation financing, the down payment is not based solely on the purchase price. The down payment is based on the purchase price plus the cost of repairs. The borrower is not allowed to be their own contractor on a renovation loan. It is extremely important to establish a timetable with your contractor to complete the project, as a renovation loan is locked with an expiration date for completion of the project. This timetable ensures a proper length of lock and may lead to additional costs if the timetable is exceeded. Fees are higher on a renovation loan due to the additional costs associated with this type of mortgage. For example, a renovation mortgage requires validating contractors, escrow holdbacks, processing draws, and may include multiple inspections. In some cases, third-party consultants are also required. Interest rates may also vary on a renovation loan versus a non-renovation loan due to the additional time it takes to complete the project. There are differences between various types of renovation loans, including but not limited to things like credit score, loan-to-value, maximum loan amounts, costs of repairs, allowable or non-allowable repairs, time to complete the project, the number of contractor draws, and the number of property units, to name a few. For answers to more detailed questions or to learn more, please reach out to your PrimeLending loan officer to discover what renovation loan is best for you.